What's your take on the Greece situation? How does that and Europe in general play into fixed income investing in 2012?
Well, let's start with the latest news. Greece and the restructuring event, it's gotten a lot of headlines. I think the most important thing is that much of what has occurred has been the good outcome. That is, the default event has occurred without destabilizing the markets, at least as far as we know here on the Friday that we're having this conversation.
For today, yeah.
in which it occurred, because most of the events that have transpired have been as expected. So there's a lot of focus around the enactment of the collective action clauses, the triggering by ISDA of the CDS. These were all market expected events. So in that sense, it's less newsworthy than it might otherwise seem beyond the big headline.
And then for 2012, how do you play fixed income investing given the risk of Europe, considering Europe still somewhat of a risk?
So let's talk first about the impact on U.S. fixed income and draw a distinction between investing in European fixed income. It's a very different impact. Right. For most of 2012 and really what happened at the end of 2011, the impact of Europe's sovereign crisis was to hold down the level of interest rates. And what we've seen since the easing of the European sovereign crisis is that we've replaced that with expectations of Fed activity. So when we put it all together, what does it mean? It means that interest rates are 100 to 150 basis points in the 10-year level below the level that we think they otherwise would be without these impacts. So what does it mean about investing in fixed income? It means you don't want to take a lot of duration risk. You don't want to have long maturities in your portfolio because we don't think you're getting paid for that risk. And we think that there's more risk of an increase in interest rates, even though we don't expect a big increase in 2012, than there is opportunity in the form of big declines in interest rates for 2012.
And with all these moving parts, how do you position yourself?
So it comes back to that first comment I made a few moments ago, which is because of all these moving parts, because of the impact of the Fed and global central banks on the fixed income markets, interest rates are not reflecting their fundamental risk. That means you are disadvantaged in investing out the yield curve. So what does it mean? It means shortening your investments on the shorter part of the yield curve. That means giving up income, so we're going to replace that lost income by not taking interest rate risk where we don't think you're getting compensated for it, and taking on credit risk. That means investing in corporate bonds. That means going out into high yield. It means going global for emerging market. Local sovereign debt is an area that we like, as well as emerging opportunities in the corporate space in emerging markets. But it means taking credit risk at this point in the credit cycle, not taking interest rate risk.
This market is
stock pickers market.
Stocks have rallied this year.
We're coming into a Monday where we're going to